Let's talk about the weakness that we have seen creeping into the Naira exchange rate against the US dollar, Yetunde. And perhaps you can give us a perspective of what exactly is driving this weakness.
Okay, good afternoon. Thank you for having me. The market closed at about 154.10 today from opening levels of 153.8. This will be on the back of increased demand in the face of static supply. The CBN has supplied about $500 million at the auction this week. This is $150 million lower than the amount supplied last week. We have also seen some oil company flows, but if we were to do a month-on-month comparison, the 1.2 billion sold in January and the 900 million sold in February shows a 300 million shortfall. But considering that February is a 28-day month, you could say that some of the demand in February has trickled into the early days of March. But the major driver for the depreciation in exchange rate right now will be static supply.
Yeah. What's your sense of the central bank's move on this? Because we have had the central bank governor himself saying he very much remains committed to keeping the exchange rate around that $150 level. Are we likely to see that resolve weaken in defense of the growing demand for the Naira, for the dollar?
No, we don't see that resolve weakening. The central bank will hold fast to the 150 plus and minus 3% band. In the midst of increasing oil prices, the reserves are buoyant. Oil production levels are meeting the OPEC quota, so we don't expect to see too much pressure on the exchange rate. So we expect the central bank to maintain and are likely to intervene when they feel uncomfortable with the interbank levels.
Yeah. Now, why have they been unable to supply the dollars that the market requires? Because you just said now that we've got a shortfall of around $300 million, do you think?
The shortfall, I would say, is not $300 million. At the last auction, they offered and sold $250 million. So the overhang was about $100 million. So that would naturally be added on to the next auction, and that's the overhang that we've been seeing in the market over the past week. Well, this overhang could also be taken out in the interbank market. So at the next auction, you could either see that $100 million coming through and the CBN offering about $250, which they have done, but they are still committed to maintaining the exchange rate at those levels.
Yeah. Let's move on now to the fixed income market. Now, we know that AMCON has been in the market again to purchase more NPLs. What kind of impact do you see this having on the overall market and also generally on liquidity?
Okay, the AMCON purchase is supposed to be effective by the 31st of March 2011. This is in line with the deadline they said to have purchased on all NPLs by then. AMCON has said they are going to need to issue about 500 billion additional bonds to achieve this, and they're also expected to issue tradable bonds. So when they do issue the tradable bonds and at a coupon higher than the FGN curve, we could see liquidity from the interbank market moving into those AMCON bonds, provided of course that the primary market dealers are geared to trade the bonds, thereby unlocking the liquidity in those bonds to the banks that are willing to sell on a one-way basis and also improving secondary market liquidity. Yeah.
So where does that leave then the bond curve? Because we also have at the same time inflation ticking up, and on the other hand we've got a weakening currency.
Okay. The bond curve has stabled somewhat. At the last auction, the 3-year printed at 9.25 and the 5-year at 11%. The initial reaction after the auction was a drop in rates, but when the inflation results were released, like you said, came out at 12.1, up from 11.8% in December, we saw rates go up slightly. However, there's been a lot of demand at the short end, market players looking for where to put their Naira. So we've seen short-end bonds come down below auction levels, but reduce interest on the 5-year bond, and that is still trading above the auction levels. Yeah.
Talk to us quickly, Yetunde, if you can, about the expected changes to the way the central bank implements monetary policy. What exactly are they thinking about?
Okay, the central bank released the paper and also engaged market players on the changes they are looking at. The first of which is a modification of the cash reserve requirement. They're also going to modify the process and in managing the liquidity base of banks, and they're also looking to improve central bank disclosure on money market activities. As far as the cash reserve requirement is concerned, they are going to eliminate the cash reserve account where about 2% of total industry deposits has been sterilized with the CBN. So they will release this into the market. They will also introduce reserve averaging over a maintenance period of about 4 to 5 weeks, depending on the timing of FGN flows. The maintenance period used to be 2 weeks prior to now. So the central bank is going to they are going to pay interest on excess balances in the operational account of banks, thereby eliminating the standing deposit facility, meaning there is no need for banks to intentionally make a deposit to the CBN. Your account would automatically earn an interest. They would also include the AMCON bonds in the government securities that they're going to use to manage the liquidity base, and they're also looking to reduce the size of the two-way code dealings they have from time to time in the treasury bill market. So from average volume of about 1 billion and 2 billion, they're looking to move to the standard market volume of 250 million. All these changes are expected to create stability in interest rates, such that interest rates will begin to track MPR more closely. Would also have a reliable money market curve, which would lead to active bond trading. I would also create a good foundation for the foreign exchange forward market.